And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak to you about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon-to-be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this interesting, there's no law that says you can't share it with them. So go ahead and hit the click the share button below. I apologize in advance. I'm a little bit under the weather, and that might impact my voice. I've been sort of going back and forth with losing my voice. Right now, sound is actually coming out, so I said, let's give it a go. Okay. I had a fascinating meeting the other day with a regulator, believe it or not. A local regulator in my industry came. I had a really interesting conversation with them about a whole bunch of different things. But one of the topics they asked is, well, what do you do with clients? Do your clients get all nervous when the markets drop, like when Corona happened or other sizable markets drop? Do they get nervous? And they were astonished when I said, well, they get nervous. Everybody gets nervous when they're losing money, but that doesn't mean they necessarily call me to panic. And they were like, well, why is that? I said, well, because I think part of being an advisor is, number one, to educate clients as to the fact that can happen, right? Markets can drop, they can drop fast, they can drop hard. It's part of, it's part of the process. Part of investing is that you have to understand that markets can drop. The second reason I said is because if the client is well allocated in their portfolio, meaning the ratio they have between linkage to the, exposure to the stock market and that to fixed income, to bonds, to CDs, more conservative investments, is determined by their risk level, by their time horizon. And then if they're allocated correctly, it again shouldn't make much of a difference. Let's talk about that, right? So if you're somebody who needs the money in a year from now, so you have no business really investing in the stock market, right? You can't afford the risk. If the market drops 30% tomorrow in the next couple of weeks, and you need the money right then, so you're up the creek, right? So there's no reason for you to have that exposure in the first place. So you'd have a much more conservative portfolio, probably just bank deposits, CDs. Leave the money in money market and earn interest that way. Conversely, if you don't need the money for the next 20 years, okay, so the market dropped. It's not fun, looking at your statement and saying, oh my God, I lost 30%. But trusting the process, knowing this is not the first time that has happened, right? Markets go down on average 10% once a year. They have a 10% drawdown at least once a year. Okay, so that's pretty big. If you're aware of that, if you understand that, if you know that that's going to happen, okay, so the market dropped, big deal. I know I'm in it for the long term. I trust the process. Historically, there's been nothing, past returns are no indication of future results. We know that. But the historical data all shows that, 10-year periods, the market's never lost money, let alone 20-year periods. So that's incredibly important. The two go hand in hand almost, right? Allocating your money and being educated, understanding that this is something that can happen. One of the things that I find interesting in the whole push towards do-it-yourself investing, don't pay an advisor. Over 20 years, it's going to cost you 10% of your money, right? Buy the cheapest ETF, even if the difference is like a thousandth of a basis point. What people miss is the psychological aspect. I see this all the time. You know why I know? Because after big market drops, I get a lot of calls for people who are do-it-yourself investors, and they just can't handle it. They get panicked, right? So you really, really have to know yourself. Before you take that advice, put all your money in the S&P 500 and go home, do it yourself. Realize that not everybody is actually able to execute that plan over the long term. In fact, I think a lot of people, I don't want to give a number, I don't want to say most people, I don't know that, but I just know, right, from my unscientific business that many people aren't able to handle it. And there are people out there all the time, right? Just do it yourself. They might run an investment camp. Just, you pay them and they'll give you the secret sauce so that you can then do it yourself. Okay, the only problem is when things happen. I'm not even talking about when life happens and you have to figure out how to pay for a wedding or how to retire or how to estate plan, all the complicated things where it really, that's where the advisors really kick in. I'm not even talking about that. I'm just talking about the fact that what do you do when the market drops 25%? A lot of people are not able to handle that, especially if they've never been through it before, especially if they've never been educated as to the fact that this can happen and will happen and happens relatively often. This is not going to be a pitch for using an advisor. That's not the point of this. The point of this is that it's really important to make sure that your money is invested, is allocated in a way which really meets what you need the money for, right? People say, "Oh, I need the money in 2 years. Put money in the S&P 500. What can go wrong?" Well, 35% can go wrong. That's just dumb. Okay, this is not smart. You really, it's not just a mantra of mine and other advisors that, the money has to be invested in order to meet your goals and needs, and to define what your goals are and what your needs are. It's not just, it's not just cliche that we say that all the time. I know I sound like a broken record, but it really is true because it helps protect it. It's part of risk management. If you want your money to ultimately work for you, which is the goal, right? Getting buried with the most amount of money isn't a goal that's particularly relevant to most people. Like, who cares at the end of the day how much money they put in your coffin, right? The point of the money is for it to serve purposes for you to live off of, maybe to enjoy some of it, to give away in charity. That's the point. And you need to make sure that your investments are actually in line, in tune with whatever those goals are, short, medium, and long term. And too often I just see from people who are trying to do things yourself that it becomes a mess and they don't know what they're doing. Because it's really easy to make money in the markets when the markets are going up. I'll tell you that it's true, right? That's easy. It's hard to make money over the long term when markets drop. It's hard to figure out, how do I pay for, my daughter's or my son's wedding when, it's 20% of my net worth. Where do I take that money from? What do I do? How did we even analyze? So something to keep in mind, the importance of asset allocation, the importance of, I would call it goals-based, right? Goals and needs-based investing. So the money is really lined up with where you're holding now, and where you want to be, in the short, medium, and long term. It's so important. You've been tuning into the Aaron Katzman Show. We speak to you about your life, money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to the YouTube channel and to the podcast. Thanks so much for tuning in, and we will speak to you soon.